We're going to get the revisions for last year next week, and there may be as big as an 800,000 job downward revision. Again, this would be the second downward revision, so I'm not sure what these people who collect the data have been doing.
1.7 million jobs have been found out to be fake. The BLS is a propaganda machine designed to create an illusion of a strong labor market. Now, when we add Tuesday's negative job revisions of 911,000 to the negative revisions last year of 818,000, that's over 1.7 million fake news jobs. With just the latest revisions, we went from roughly 147,000 jobs a month all the way down to 70,000 a month, which is less than half. Now, how do you make that type of error if not for intent and negligence? Now, we're going to go into that, and we're also going to take a look at the market's reaction to all of this data. And we're going to talk about what happens to the stock market once they start cutting rates again, which is probably going to happen in about 1 week. Now, having said that, you guys, happy Wednesday, good morning, and welcome back to Real Estate Mindset. You guys already know that this video is going to be absolutely bonkers. Mitch Vexler, good morning, sir, and how are you?
Good. The manipulation of the data is something that we have been jumping up and down about for almost 8 months. And when you go to the websites, Travis's, mine, or Jeff's, you begin to see how this math that has been promoted doesn't stack. And as it turns out, even at the federal level, what you think would be legitimate and honorable turns out not to be legitimate or honorable. And it causes huge gyrations in the truth. And if you don't deal with the truth, you cannot get to the solutions of any of these problems. And promoting the fraud ends up in promoting inflation, both the federal level and the state level. And that is what we as mom and pop are dealing with.
And to your credit, Mitch, as the viewers know, on yesterday morning's video, I guessed that the revisions would be over 1 million. I cornered Mitch and he said under 1 million. So Mitch Vexler was right because we missed it, barely missed it. I was barely wrong. But what did happen is this data revision ended up being the largest data revision in history. September 9th, 2025, the current employment statistic preliminary benchmark is out. The preliminary estimate of the current employment statistics, or the CES, is a national benchmark revision to the total non-farm employment for March 2025, which is a downward revision of 911,000 jobs. The U.S. Bureau of Labor Statistics reported today the annual benchmark revisions over the last 10 years have an absolute average of only 0.2% of total non-farm employment. So we've exceeded that average greatly with negative 0.6%. There's a final revision to this revision. That final benchmark revision will be released in February, all the way to February of 2026, with January 2026 employment situation news release. Now, when we break down where the revisions occurred, it's a little bit alarming, especially when we look at information. Now, it doesn't seem like 67,000 is a lot, but I'm looking at the percentage. They were off by negative 2.3%. That is a massive discrepancy in data. Someone's not doing their job right, clearly. But the industries with triple-digit reductions is number one, wholesale trade with 110,000 jobs. Number two is retail trade with 126 jobs disappeared. Number three is professional and business services with 158,000 downward revisions to jobs. Number four is leisure and hospitality. And that one makes a lot more sense because when they said they added leisure and hospitality, I was like, how is that possible heading into recession? But they've removed 176,000 jobs from leisure and hospitality. When I look at that revision, to me, it makes perfect sense because like I told you guys yesterday, the job openings are down and the employment is up. So how could they be adding enough jobs to sustain what's happening in the economy right now? And as you guys can see, not only are job openings down, which you guys see right here, they are down big. There's still 7.18 million job openings. But remember, this data is constantly being revised. And I want you guys to pay attention to the peak. We had in March of 2022, 12.1 million openings. So understand we've lost 5 million openings, job openings, at least 5 million because they revise this, since March of 2022. At the same time that job openings are going down, when we look at unemployment since August of 2022, you can also clearly see that unemployment has been going up. So job openings going down, unemployment going up, no job creation, which is why I pointed out that this information was extremely wild, because when we look at the BLS job report, section A9 for full-time and part-time jobs, and you look at the year-over-year data, which is comparing the yellow to the blue, this is showing, according to the household survey, a gain of 1.9 million jobs. So that's why, as I told you guys yesterday, I said that we're probably going to have a revision of over 1 million jobs, because this data does not match this data and this data. You got to pick either good economy or bad economy, but what they're doing here is total propaganda that's simply designed to continue to keep us spending. They want us to keep our guard down so that we think everything is perfectly fine in our lives and in the economy, so that we, you and I, continue to prop up these prices. Don't forget, you guys, yes, Federal Reserve is horrible, Central Appraisal District horrible, but it's you and I that are really propping things up, because we are responsible for 70% of our GDP. So mom and pop are very important. Now, Mitch Vexler, my question to you is what does the largest data revision in history tell us about the United States economy?
What we have here is a story of the flaw of averages. And Travis just mentioned the idea of hospitality dropping 176,000 jobs. The problem is when statements are made that are statements made on the gross calculation, well, that creates a flaw of averages. So you say, well, the hospitality industry, well, the problem is inside the hospitality industry, you have 2-star, 3-star, 4-star, 5-star. And if you look at the 5-star hotel world, it's actually doing well. The upper end luxury is doing well. The 4-star is hemorrhaging. And there's multiple reasons for that, including age of the facilities, and that it takes a certain amount of labor to operate a 4-star as compared to a 3-star. The 3-stars are doing okay. So one has to then ask, where is the dominant factor of those people getting laid off coming from in order to paint the correct picture, which is tell the truth? Problem with the numbers as presented, you can't get to the truth. They're lumping everything in. So it stands to reason that if the 5-star is doing well, the 3-star is okay. Well, obviously everything in the 4-star world, give or take, is hemorrhaging. And that's where the focus has to be, because a lot of those hotels end up with commercial mortgage-backed securities, CMBS. That starts problems on the real estate side. Well, this discussion that we're having also goes to certain elements of retail. So as the economy gets weaker, which retailers do better and which retailers do worse? The problem with the idea, well, a certain amount of retail labor has been laid off, doesn't paint the picture. It doesn't tell the truth. It's the flaw of averages. Lumping everything into a larger category is a flaw of averages. And unfortunately, that's what you're seeing with the BLS, because can't get to the truth unless, as I've been saying, you walk the street, you drive around, you see what's happening, and you say, okay, that retail is bad because in the economy we have X problem. The point of the matter is be very careful when people are lumping numbers together.
Yeah, at first I thought you were talking about the ISD bond debt lumping together, because they're the masters at lumping a whole bunch of money together so that as taxpayers, we can't see how they're spending our money. And I forgot to tell you guys, as the viewers, at the end of this video, we're going to give you a full update on the bill to abolish property taxes here in Texas, the lawsuit with the Texas Supreme Court, and the lawsuit against the Central Appraisal District's Steve Friends, who assault and battered me. So stay tuned to the end. But right now, Mitch, I want to get the reactions of the market, and then we're going to show the viewers the historical data changes. But let's start by getting the reaction of the White House.
Has released the largest downward revision on record, proving that President Trump was right. Biden's economy was a disaster and the BLS is broken. This is exactly why we need new leadership to restore trust and confidence in the BLS's data on behalf of the financial markets, businesses, policymakers, and families that rely on this data to make major decisions. Much like the BLS has failed the American people, so has Jerome Too Late Powell, who has officially run out of excuses and must cut the rates now.
And now CNBC's reaction.
I see the biggest revision we've had. I go back 25 years here. This may be the biggest revision ever, Sarah. We minus 911,000 payroll growth from April of 2024 through March of 2025 is 911,000 less than previously reported. What has happened now to the month over month, or the monthly growth rate, has gone from what we thought was 147,000 a month to now just 70,000 a month. So 1.7 million jobs is now 847,000 jobs created over that period. So over that time period, payrolls were quite a bit weaker. Remember, this is the period ending 5 months ago. This is the annual benchmark revisions that's done every year. This is a preliminary number. Over time, it tends to actually be revised a little bit higher. The revision to the revision ends up being a little bit higher, but right now it's suggesting much weaker payroll growth. I will point out that this is definitely towards the high side of what I've seen from Wall Street analysts. And now you have to plug in you have to start thinking about, what does this say about today?
And a brief reaction from CEO Jamie Dimon, who says the economy is weakening. Now, I want to go into the historical data changes so you guys understand just how bad this is. This is the biggest revision since 2009, when the Bureau reduced non-farm employment by 902,000. So the record was held in 2009 with 902. Now, the last one that we had last year of 818,000, that used to be the second largest. That's now the third largest. So again, we have back-to-back number 1 and number 3 largest revisions in history. And when I scroll down here, you guys can see that chart, which is the revisions to total non-farm employment, March 2023 through March 2024. You guys see that right here. So this is not today's. This is just everything but today, going back to 2003. So here's the 818. Before that, it was a downward reduction of 187,000. But what I wanted to point out is right here in 2010 at 378. So that's roughly 1.2 million fake jobs back then. So right now we're exceeding that. The only difference is back then the administration acknowledged publicly that we were in recession. Right now they're not doing that. Unfortunately, the economy currently needs to produce an average of, you guys ready? 180,000 jobs per month to keep up with population growth, and neither revised numbers do that. Okay, so we're at 70,000. They're saying 180,000. And still, there are some people with their head in the sand on what's going on in the labor market. When I go back to this article from December 27th of 2009, I wanted to remind you guys what happened in 2009. With a 10% unemployment, 2009 draws to a close, leaving millions of Americans without jobs. Even those who still have jobs feel beaten down. Sound familiar? The recession took its toll on the form of job cuts, furloughs, and wage and benefit reductions in just about every single industry. And I just wanted to show you guys the top 4 industries back in 2009 that have job cuts. The number 1 was actually architects. Interesting. They had job losses of about 17.8%. Number 2 is carpenters, also very interesting, 17% down. Now look at this, production supervisor and assembly workers, that fell 16%. And pilots plummeted by 30.4%. Just one more video about PMI and a couple other recessionary indicators.
Meantime, Dow with some moderate gains here up 25, getting some services PMI. Let's get to Rick Santelli. Hey, Rick.
Yes, these are August finals on the S&P PMI service and composite, and we're losing some ground here. What was originally reported at 55.4 for both of them gets downgraded. For the service side, down to 54.5, which goes from the second strongest number to now we're comping to June where we're just a whisker under 53, and the composite moves to 54.6 from 55.4. Also, this the weakest just since June, but it really is a downgrade. And the initial reaction in the markets on the interest rate side was a little bit of buying, pushing yields down, but it's leveled off. most of the volatility was this morning on the ADP jobs number, which came in a little bit light, which kind of put the low spike on rates. If we look now at a 4.18 10-year, that's down 4 basis points, and it underscores how JOLTS changed the landscape yesterday, coming in on the weak side and turned what was a seller market pushing rates up to a market of covering in front of what will be tomorrow's important job report and next week's super important CPI and PPI reports.
Mitch, your reaction to what we just watched, and also can you answer the question, when do you think they're going to officially call a recession?
When we're in a depression. They're lagging, right? That's the reality. They won't call it until it's an out-and-out disaster, and that's why we're doing what we're doing at the Central Appraisal District level, because there are ways to fix this. There are ways to put a bracket on the problem or put a floor under the problem so that you know where the floor is and you know where the roof is, and you quantify those dollars in between. You go to work on those dollars and the damage. So on the school district level, it's about 5.1 trillion. On the Federal Reserve type level, well, to be determined, but between friends, let's call that another 20 trillion that there is a solution for. And President Trump on the top line is in the right path with regard to the tariffs. On the bottom side of the equation, which is mom and pop at the property tax level that nobody wants to talk about, that's the bracket on the lower side. You fix the property tax, fix the balance sheet for mom and pop so they own the land beneath their feet. And on the top side are the revenues generated through the tariffs. And then you start working in the middle to eliminate the damage that is being done by the Federal Reserve. There are answers to this. The problem is nobody wants to talk about the answers, because in order to talk about the answers, certain divisions of the government are going to have to admit we screwed up. And therein lies the problem, because no division of the government wants to admit that they screwed up. However, towards the end of this, I'm going to prove it.
Mitch, what's interesting is some people are saying that this is just kabuki theater, and they're doing all of this so that they start the rate cut campaign in 1 week. Let's talk about interest rates now, starting with CME Fed Watch. Okay, so this is the market's expectations on what's going to happen on September 17th. So in about a week, when it comes to the federal funds rate, right now the market is saying 91.8% chance of a 25 basis point cut and an 8.2% chance of a 50 basis point cut that you guys see right here. They are planning for keeping the rates the same. The market is saying you are going to cut the rates in September. That's what the market's saying according to this. Today, the 10-year has actually gone up slightly over the news. You guys can see, for some reason, and I didn't expect this, actually, the 10-year went up after that news. It's sitting at currently 4.07%. Now, in turn, that's brought residential mortgage rates under 6% as far as the 30-year FHA. And also remember this, you guys, generally, and I'm not a financial advisor, but I'm a licensed loan officer, residential mortgage loan officer. Generally, if you shop your mortgage and generally if you go to a broker, you get about, and have good credit, okay, you get about a 0.5 point off of what you see here. Remember, the upper left is conventional, so conventional on average is still above 6%. This is a pretty good article that came out yesterday, September 9th, titled "Why JP Morgan is Warning the Fed Rate Cut Everyone Expects Could Actually Sink Stocks." Very interesting stuff here. Since Fed Chairman Jerome Powell's comment that a rate cut could be justified at the Jackson Hole last month, the S&P has gained nearly 2%, bringing the year's total to just over 10%. Absolutely insane. Traders now expect 3 rate cuts in 2025, starting with a 25 basis point rate cut this September 17th and several in 2026. Many say could help juice the stock market that has shook off all manner of perceived headwinds this year and last year and the year before. But what if that much awaited first interest rate reduction causes stocks to drop? That's the message from our call of the day, as JP Morgan's trading desk warns clients that a potential sell-off could be ahead. Concerns that the September 17th Fed meeting, which delivers a 25 basis point rate cut, could turn into a sell the news event as investors pull back to consider macro data. Fed's reaction function potential stretch positioning a weaker corporate buyback bid, a waning participation from the retail investor. Breaking that down, starting with macro concerns, Tyler and his colleagues say that with labor supply waning, rate cuts could spark more demand for workers, triggering sticky wage inflation. Inflation-related comments from public and private companies suggest more tariff-induced cost pass-through is coming. As for stretch positioning, the JP Morgan team spoke of above average but declining exposure to U.S. stocks, with hedge funds small sellers of North America and Asia Pacific. Citigroup strategists also spoke of easing momentum for U.S. stocks in a note that was published on Tuesday. And while share repurchases from S&P companies hit a record in the first half of 2025, Goldman Sachs said that it's been stalling as of late in a note to clients on Monday. Finally, JP Morgan speaks of a waning momentum from retail investors who have been buy the dip force for stocks this year, forcing bigger Wall Street players to catch up. Seasonal factors appear to enter in here, with Citadel Securities strategist Scott recently pointing out how retail options volume typically wanes in September before rebounding into the final quarter of the calendar year. The sell-off might not last too long. Tyler and his colleagues are sticking to a lower convincing tactic bullish call on equities, as they say the current bull market for stocks seems unstoppable. They see an AI theme reemerging as a significant support for stocks. Mitch, any ideas about what's going to happen to the stock market once they start the rate cut campaign again at the Federal Reserve?
Over a short period of time, more than likely, the market will head down. So everything that we're speaking about here is time-based. And the reason why it heads down is because dropping interest rates is indicative of a weakening economy. Problem is with that statement, it's not necessarily the economy as much as it is the cost of the debt that has been compounded on the economy. Again, flaw of averages and not telling the truth. It's the interest carry that has turned into our national deficit of roughly 1.8 trillion in 2024. And it looks like we're going to beat that this year. And therein lies the problem. It's the interest carry, it's the deficit. And if you don't tell the truth, you can't deal with it. So what are they really doing? The economy is the economy. It's the cost of carrying the economy that is the problem that the Federal Reserve participated in full throttle by printing money. They created the fraud, just like the central appraisal districts. These things are neck and neck in what they've done. And therefore, more than likely over the short term, yes, the stock market will go down and it's going to bounce in between. And you can say on a monthly basis, okay, it's going to be within a 1.5 standard deviation. And all that is true. But most people don't have the ability to trade it. So generally, of the short term, down.
And Mitch, I want to read this last comment on this article and let me know whether or not you agree. One suggestion from Tyler and his colleagues is that investors may want to consider upping their gold. What are your thoughts on that, Mitch? You think they're accurate with that statement?
There's different ways to get into precious metals. Again, if one knows how to trade, they can be selling puts below the market and praying to be hit. In other words, the puts get called and you get the gold in exchange. So there's different ways to do it. But if mom and pop has excess cash, and I mean excess, where they don't, even no emergency savings, that kind of thing, they don't need it, then you have additional money in the bank earning, let's say 4.5%, maybe 4.7%, versus what silver has done, as an example, just in the last 10 days, well up over 4.7%. Why would you keep your excess cash in something that's basically dead money? You're better off, given where we are economically, putting that money into something that's productive. It could be buying a company. It could be paying down your own mortgage. It could be doing something that generates additional revenue. Even a dividend stock, if you believe in that. I'm not a fan, but if you do, at least you're doing something with the money that's more productive than just letting it sit in the bank. And paying off your mortgage actually generates more money than what you would receive by letting that money sit there in the bank on a CD. Something to be looked at. So precious metals, at this point, even though we're hitting all-time highs on gold, I think it was 3,700 this morning, that, yes, is 3,700 today. And yes, I am expecting a pullback of some kind. But the point of the matter is, it's going to keep running. The more problems there are in the economy, the more printing of money that appears that will be necessary at the Federal Reserve. Why would you leave your money in the bank? It doesn't make any sense. And then when you realize that, give or take, there's 600 banks that are in trouble out of the 4,700 remaining, why would you not want to take protection of some kind? Now, whether you're in at 10%, 20%, 30% of your net worth, that's up to you, but at least the considerations should be there. And having some money put away, even if it's buried in your backyard, it's yours and nobody can take it.
And Mitch, speaking of record highs, let's go into our property tax segment now, and let's give the viewers a very quick and thorough update on what's going on. But moving into that segment, I want to watch this video first because I want the viewers to always understand how big a problem property taxes really are.
Off our houses, why do we still have to keep paying property taxes? And someone in government, please explain that to me. Like, what exactly do we get for the property tax money? I mean, other than getting to stay in our house that we've paid off and supposedly own. Like, if I didn't pay that property tax, you'd take the property. So in essence, I don't really own it. Like, who in the government came up with property tax? Who thought that would be a good idea? I'm never going to own my house. The government still has their fingers in the pot, and your pot too. And everybody's pot. All right, rant over. But can someone explain property taxes to me?
Let's give the viewers an update on the amicus you're working on that you're requesting people sign. Let's give them an update on the Texas lawsuit at the Supreme Court, and also on the people's bill to abolish property taxes. And to the viewers, I've had a couple of you ask, what's going on with Steve Friends? I want you guys to know, a couple of weeks ago, Steve Friends, the guy that assaulted me at the Central Appraisal District, that lawsuit has been served. He is being sued, and there are also pending criminal charges against him. So that's the update with my little tiny lawsuit. Mitch, can you give the viewers an update on the other three things that I mentioned?
With regard to that gentleman on that video, the quick answer would be the road to hell is paved with good intentions. And more than likely, these things started out at one time with good intentions, but have morphed into extreme moral hazard. And with regard to the top dead center of my website was a Freedom of Information Act request that was sent to the Attorney General and the state auditor. A response has been received, which is also now top dead center on the website. They can't confirm that they're not breaking the law. The Attorney General and the state auditor and the state comptroller in reality are claiming no enforcement. So why is there denial of the information that has been requested? And the position that is clear, how do you know that the bonds can be paid off? The bonds that are outstanding, how do you know, every one of us that's watching this video, how do you know that the school district bonds can be paid off? They won't deliver the QSIPs. They deny the median household income. So how do you know that the QSIPs are being used when the Texas Attorney General, the state auditor, the state comptroller, BRB, the Texas Education Agency, the school district superintendents, and the chief appraisers don't and or won't turn over the QSIPs? The QSIPs are the packaging of the bonds that says what was done, who did it, what was the term, what was it for, and when was it paid off? Think of this across the United States. Leave Texas alone for a second. They won't deliver the QSIPs in Texas. And if the other states are similar where you can't get your hands on the QSIPs, well, what does that say about the government doing its job to protect the citizens via the laws of those states? The point being that these entities are government entities and they chose their actions. They chose to do this by law, which is why we are at the Supreme Court as we speak and why we're in the process of writing an amicus brief on this very topic. these entities, these government entities, do not have sovereign immunity to commit fraud. I'm certain the Supreme Court is not going to allow this to happen, be it Texas and or Supreme Court of the United States. The ARB panels are being used as a weapon against the property owners. So the Appraisal Review Board are literally being used as a vehicle that is, in fact, a get out of jail free card for those who are violating the law. What has happened, nobody has denied in the previous courts that the fraud has occurred. What they said was it stops at the ARB. The problem is that the ARB itself violates the laws written by the Texas Supreme Court. That law, for those who want to look it up, is Patel. The point of the matter is the Supreme Court wrote the law. We're writing an amicus brief to explain all this, but the net result is that the government entities at this point have proven that they themselves have violated the law and failed to protect the property owners. The ARB is the pawn. They're the ones that are going to get hung out to dry on this, and as well as the superintendents who committed accounting fraud, and as well as the chief appraisers who have committed accounting fraud, which all leads to the bond fraud. So the point is that these things are now happening. I hope to have this amicus brief out. I thought by the end of this week. This thing is a beast. I've been on this now for 10 days, and we're starting to bring it down and narrow its focus more towards the ARB than we are with regard to the trial notes. And when we learn something, I want to make this point, as we learn it live and as we execute it live, we do a video. Every time we learn something, we share that. And we want that known to mom and pop. We want it known to the government because we're not hiding anything from anybody. We're doing this on purpose. We're literally telling these people, you broke the law. If you refuse to do something about it, well, in the eyes of the law, you're guilty. And at some point, this is going to be on trial for fraud. And these people are all going to have a problem. And that's what I said before. When you realize the depth of this, the government is going to have to admit we screwed up. Now we've got to get busy to put a floor and a ceiling on this and start squeezing to fix the problem. There are solutions, but we have to get there real quick, because if the market makes that solution for all of us, it's going to be really bad.
Yes, sir. Those windows of opportunity for a solution are closing, and they're closing rapidly. And now my call to you, the viewers, for help. Don't forget, you guys, go to the link in this description. Go to Mitch's website, Mockingbird Properties /DCAD. Go to realestatemindset.org. Take the videos, everything free. CommonSenseLaw.org. Go there as well. He's helped the FBI take these schools down. Look at all of this stuff. And also, if you want to be more social after this video, join our new Facebook group, also linked in the description, and join us in this fight, because you guys already know we definitely need your help. Now, other than that, we really appreciate you guys. Let us know how we did on this video. Let us know what you learned, what you didn't learn, and how you're doing overall in this economy. Now, having said that, you guys already know we wish you luck, and we hope you win.